Hi, folks. Welcome. So, today I'm going to dig a little bit deep into the most important elements or components when it comes to trading or building a trading career. Yes, as said, uh, trading is like a business, so it has to be treated like such, right? That is obvious and uh, it's straightforward. But how do you run it as a business, right? Because our customers um, methods it's a little bit different from an outside business, right? So I'm gonna bring out the most important components for you to build a strong business in trading, right? And I'll try to break it down to an extent that you're able to grasp each and every one of those three and apply them into your trading desk. The first one is managing your risk. Managing your risk is quite important in a way that for each and every business, we know their losses and profits, right? So when it comes to trading, your loss is your loss, but you can determine where your loss has to stop or end. So we do calculated risks and uh, knowing where exactly is our loss going to be. So let's get a little bit into detail in terms of what a risk management is. Yes, there are rules, there are percentages, and there are all those things. For me, I just want to be honest with you, right? You as a trader, you need to come up with a solid risk management plan. The only thing that matters is no matter how good your strategy is, no matter how much experience you have, is not to risk all your capital in a single entry or in a single trade. That is basically the basis of risk management. You are allowing yourself to have another entry when another opportunity comes, no matter how your setup is, no matter how good you are a trader, no matter how much your setup has been doing well, right? So, conscious, do not risk all your money in a single trade. So, how I'm gonna break down a little in a way that, let's say you are a newbie or someone who have been really struggling with risk management, right? Here are some of the tips that I can share with you. Let's say for example I've um a good amount. Let's say I have $1,000 account, right? Mm, this is just a typical example and a tip as well. For you to do the calculations and find out where should I put my stop loss and all that and all that, it's really at some point time consuming, although it's important, right? So to avoid, first and foremost, to avoid an account damage, um, what I will do is I will remove. I'll open, let's say with the broker, I'll open two or three accounts, right? Three trading accounts. Um, I'm sure a lot of broker does that. That's that option of opening two or three or four trading accounts. Yeah. So you have your main account with the $100 account, and then you can transfer internal transfer, probably $50, right? If you want to risk $50 per trade, you transfer it into another account, then you trade with that account, right? So that this $950, it's separate and it's not going to be affected somehow, right? So if you say I'm risking $50 per trade, then this can be the easiest way. That really helped me. Then for me to do the calculation of the stop loss, and sometimes the spread is a little bit higher, so I will end up losing maybe $70 or $80, whilst I wanted to lose $50 only, right? So this helped me a lot, and I hope it will help you. Separate your main account and your trading account. Yeah, so if you lose that $50, then you transfer again another $50 for another trade, for another setup, for another day, or for another time, right? Is it so easy, so executable? I really enjoy do that, because sometimes we will be, hesitating to size up, we'll be hesitating to increase our lot size, because you might never know when things goes bad, right? When things goes bad, it's gonna affect your main account. So in this way of doing things, transferring your $50, it will help you to even risk up or size up nicely, to an extent that you can make more out of $50, or guaranteed to lose $50 without any excuses or any confusion of what really happened, or you end up pushing your stop loss a little bit further, all those things. So yeah, all those things can be avoided by doing this one way of doing things. And another thing is, do not, let's say you choose to trade with one account, try by all means to put your stop loss at an preferable area than pips, right? Because pips or points doesn't really matter. Try by all means to look at an interesting zone, interesting area, where it's suitable to say, okay, if the price reaches this area, yeah, for me it's a confirmation that I am out or I'm done. It's quite important to do things that way. So when you are wrong, just admit you're wrong and wait for another setup. It will absolutely, definitely, it will come, and when it come, you do the same thing, right? The mistakes that I've been making is, let's say my setup comes, and I see this is my setup, and I'm interested, I'm happy, I'm excited. I ended up sizing more, forgetting that I might have a mechanical error on my system. Right, sometimes it will go further, or sometimes due to volatility it can, and then I'll end up regretting. So sizing equally all the time, doesn't matter what time of the day, doesn't matter where you're trading in, or doesn't matter how your setup is revealing itself. It's just a matter of having a constant risk. That's what takes professional traders to the next level. And the second thing, that is what I've been talking about, is strategy. Strategy comes in different ways. You can define your strategy in different approach and all that, but what matters is a strategy is, for me, it's like a rocket launch. What do I mean by a rocket launch? I have what is known as an entry design. Entry design is before I started to do anything. I start by evaluation. Evaluation is a stage or is the time allocated for a specific reason, which is evaluation. So what exactly is evaluation in my terms? Evaluation is whereby I'm looking on higher time frame, like the monthly effect, like the weekly range, like the daily range. Now I have um, a beautiful structure on a higher time frame, in a sense where are the markets moving towards or likely to go towards, and things like time and price theory. Please look check it out. it it makes a lot of sense in a way that once you evaluate on higher time frames, it will be very easier for you to look a little bit deeper into what is likely to happen and why things do the way they do, right? So after evaluation, as I am evaluating, I'm waiting to see um, or mapping up my areas of interest in a way that I want, let's say, this zone, the price has to respect this area for whatever reasons. It mustn't break, or with a resistance, or it's a support area, whatever the case, or is a trend line. That evaluation, I'm evaluating the price behavior towards my areas of interest, and then um when there is something that seeks my attention, right? Let's say I did my evaluation, I'm done, I mapped up, I put some price alerts, right? For example, to say if the price hits this area, please let me know. And I'll start looking at the behavior of the price from there, right? So after the whole process of evaluation, and I see how the price is behaving towards the areas that I am interested in, then if there's something that seeks my attention, then I go into activation stage. So the activation stage is whereby now I am fully participating and anticipating into the market uh, according to the price action and the price behavior. All right, this is whereby now I'm having the sense of structure of the market. I am anticipating the price to move in a certain way, right? And I I'm mapping up the very key levels and the way the markets that I'm expecting to see, right, behaving. It can be things like displacement, it can be things like uh, what is this, things like is it gonna break the structure, is it all those simple things. Now I'm putting up in place the very very important things, right? Then the next step, right, this may take whatever time, it's according to the markets. I cannot be able to determine the time, how long is this gonna take, but the markets will determine how long will the activation stage take, right? And then after once I'm activated, I am expecting to see my structure coming up. Oh, it's like you are drawing, right? Then you are now starting to see the the skeleton feeding up from, starting to have a structure. That is where I am on activation, right? And then after I have now, okay, from the drawing I can see this is what is the what type of a structure is this. Then now I'm fully aware, right, on this skeleton that is being drawn here by the markets for me, this is likely to be what type of an animal, a cat or a dog or a car, whatever the case is. If you say this is a dog, now I by determining what the market is trying to show me, I then jump into the third stage, which is the authorization. Authorization is a stage whereby now I am aware of what are the markets going to give me, right? As I was saying on the skeleton example, now I'm aware, okay, this kind of drawing that the markets are drawing, this is absolutely a dog, right? But before I am fully confident, I still have, right, another stage to go through. So this authorization stage, right, is now we are aiding those important things. If we are, let's say for example, we're drawing dogs, now we're trying to see the shape of the mouth coming up, now the shape of the eyes, okay, the ears, and is the dog a male or a female? That's exactly how it comes, right? It's the drawing stratum. So how do I determine that? I'll then it's like in this authorization stage, that's where we see the price respecting the key levels or price breaking the key levels. We call this simulation and mapping, right? We have a design, we have a structure here that we are working on already. Now I'm mapping up with, here is where my entry is going to be, here is exactly where I'm going to exit and why. We are doing the measurements and the calculations of the sizing, right? We are looking into detail when it comes to the price action. Here we are using very, very small time frame, 5 minutes, 15 minutes, 3 minutes, even 1 minute. That's where we are playing it, because we are very, very fine-tuned to look into detail to see what exactly is happening, right? Each and every 1 minute candle is now counting. That's where my full attention is. Now, after all this has been happening, now everything is in place. The structure is out. Now let's do our work. My work, your work, our work as traders is to launch. Now we are launching a trade. The only thing now we have to do is we are entering the trade. We are very sure that this is a dog, this is a structure of a dog, or this is a structure of my setup. This is where I'm entering. As I enter, my exits are already mapped up. Alright. So you might find out in a way that I always want to emphasize this issue. Let's say you are entering a trade. I really do recommend that. This helped me a lot, entering with more than one entry. Right, let's say I use 0. Let's say 1 lot size. I rather break it into 2, then you have 0.5, 0.5. I'll explain why as time goes. At the same time, I am putting out my exits, right? I'm not gonna have one exit. This will help me to have multiple exits, right? Or having 3 entries or having 4 entries, right? The first exit, it's just a little it's very close to my entry. To secure this entry and exit or this trade is to secure the charges that has been caused through opening all those trades, right? Remember the spread, we get charged the spread as traders. We have to take a note on those things. So when you're entering, I recommend entering with more than one entry. Is I enter, that's how I do it. Is I enter with 4 entries or more, and after probably 10, 15, 20 points, pips, I had to take profit one day. Now I've secured my transaction cost, and then probably 30, 40 pips, another take profit. This is to make sure, yes, I am still in the trade, but if things goes to opposite direction, I really don't need to lose everything. I have to secure again, and then the last 2, I leave them run to the bottom of, or maybe to the high time frame exit. So this helped me a lot in a way that I don't feel like, oh, I've exited, now the prices keep on moving my direction. Should I enter again? So this helped me to enter once and exit in multiple exits, so that I just feel like, yeah, this is great, and I didn't have to exit and then come back again, entering again, transaction cost and all those things. Those things have been avoided, and I managed to have the full chunk. Yeah. So basically, this still comes on the launch. So when you're entering, it's great to have such pieces of entries than to have a single entry. When you exit once. But anyway, there are also other methods of exiting, but that will be time consuming, and others, they find it so difficult, and so other platforms, they don't offer such exits. So it really helped me to have multiple entries and different exits. And then the final component of your trading that is very, very important is the trading psychology. I think this one, I was in a state that I couldn't know what was hindering my progress when it comes to trading. I wasn't really sure what was transpiring, why was things happening that way, and until I encounter some psychology gurus whereby they break down some, through research and all that, I ended up coming with my psychology method of doing things, and it really helped me. Because I wasn't aware. It opened like my third eye towards the markets there. So as traders, remember, we are loners. We do these things sometimes alone, sometimes with friends, sometimes most of the times alone. Then there are things, there are triggers that happens in the market, and the triggers comes from the markets themselves, and we are not aware of what a trigger is and how does a trigger come to hit us, right? So I'll break this down to an extent that you have an understanding. So what is a trigger, and how does that affect your brain? The trigger is, I will say, is anything that the market does that causes a shift in a way you were thinking prior, or that shifts the way you do things, and you end up doing things that you really don't know how did that happen and how did I do this. So what does a trigger do? A trigger, it does activate the right hemisphere and lower brain structures. Okay, so when something like an impulsive move, a hyper move from on the markets, you're just looking and you see from the 1 minute time frame something is rushing up or down, whatever the case is, but yeah, that's a very impulsive move, and you be like, okay, should I enter or should I, start asking yourself, although your setup is not revealing itself there. And okay, things like a great previous trade. When you win on your previous trade, there is a shift, or there is an activation in the hemisphere of your brains in the lower side or lower structure. And when that happens, when you win a trade, you feel like your confidence is a little bit higher. Then things like your risk management is already affected. That's when you start to increase your lot size, or start to put more more trades, and over trading and over there. It's because of the confidence that you get from a previous trade, right? Once you have such a thing, it's already a problem. There's also, if you're not aware, a bad trade. Once you lose a trade, again, it's a trigger. Now your confidence is low. You feel like you want to trade so that you can make your money back, something like that. Not knowing that you just have to follow your strategy no matter what. No matter you win or you lose, the next entry has to be from your setup, not from your emotions. Okay? And then things like boredom. Let's say the markets are just consolidating and you are like, really, am I supposed to sit here throughout the day without any entry? Probably let me enter. So these are some of the behavior that the markets portray to us as traders, and as we are learners and not aware that the markets are creating these type of shifts to and triggers to us so that we behave according to them, right? That's how we end up losing money to the markets. So if the markets are consolidating and you be, really, let me just try to enter, or the markets have been consolidating, now there's a false breakout, you are getting caught in there, all those things, but they can only be avoided by only trading your setup. And then the other thing is greed. You are in a trade, you're in a winning good, everything is going well, you're in blues, your blood is running very fast. Remember, the trigger activates right hemisphere and lower brain structures. That hype, that joy, is activating the lower brain structures for you, and you are not aware, right? So you are celebrating, you're in a good mood, you're in a good vibe, your trade is going well. You end up adding more entries. You end up sizing up a little bit more. As you trade, you are adding, by adding, you're opening up more, things that you're so confident that you don't even know where you're getting that much confidence. That is where you start to get out of your way of doing things. So things like greed and fear are also part of the triggers. Fear can be described as doubting yourself after you're losing trade. You start to be scared. Now you're starting to miss trades, And my advice is just to take it easy. Tomorrow is another day, and you get some good um, entries. So after a trigger happens, there's a shift that comes into you as an individual. Yes, the shift in experienced state, right? Now the market draws your attention through that hyper, or that win, or that boredom, or that greed or fear, right? The market draws your attention. Now you are consumed by the market. That's when you start to have a sudden perspective change. What if it's gonna keep on going up? Let me just participate. Let me buy, or let me. What if it's gonna keep on going the opposite? Whatever the case is. Okay. Oh, this looks like it's a good move. All right. What if I'm missing out? I don't really want to miss out. I still have to cover up my balance. I have to grow my money. I just have to participate. Or this thing is going this way. Should I proceed? No, I'm not sure. Once you are in that state, you are out of your preferred, the mindset that you are working throughout your entire career. Once you get out of that, you are going back to your old mistakes. You are going back to what has been hindering your progress. This is pure psychology. This is what a lot of traders struggle much on. Once you have shifted the way you think because of the trigger, you are not going to react. Absolutely. You have to. That's how we behave. That's our behavior as human beings. We react. Doesn't matter how we are going to react. Sometimes you start to have that unwanted behavior. No, man, let me just buy. If you are just buying, there are three things that you are making a mistake by just buying. First one, that is not a calculated entry. Point number two, your sizing. You are not even going to make sure that your sizing is up to date. You are entering without a stop loss, and you are entering without a take profit. I will manage it manually. That's a total flop right there. You have created the damage. You have created a fire that have the possibility of damaging your account. If you are lucky, your lucky doesn't last. In the markets, you do not trade luck, you trade your setup. And then after that, once you have that impulsive entry or exit, or you just decided to exit, whatever the case is, you are going to suffer the consequences. And those consequences, they'll bring guilt. Once you're guilt, you lose confidence as a trader. Once you're guilt, you start to doubt your strategy. You start doubting yourself. Your money is gone. You start thinking the markets are rigged. You start thinking maybe this is not for you. You start thinking probably I'm not supposed to be doing this. Yes, it's all started from the trigger. There's a quote that says increased efforts generates rebounds episodes. Once you put a little bit more than normal effort into the market, you're going to go back to where you started. So, ladies and gents, this is from me, and I was just trying to open up and give you the three most important components that builds a trader and trading business as a whole. Once you master these three, in summary, is trading psychology, your strategy, and your money management. By having those three in place, you are likely to go far. And if you like this video, please do press a like and subscribe for more content. I only provide the real stuff. I'm not here to play around. Here's how you make 1,000 within a week or something like that. No, I want you guys to keep on making, right? So please take a note. Please take some notes. Write these important key points down. Implement them in your trading desk, and you see the results as they come through. So please, yeah, that's basically it, And I wish you all the best in your trading. It's not a coincidence that you have been listening to this. It's absolutely what's supposed to come into your ears and do something about it. And I wish you the best. And share this with your friends, and family who really needs to build their trading career, who are serious. And with this, thank you guys for watching and listening. Up until the next video, and cheers for now.